Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, April 11th, 2024. It is 10:12 a.m. as I'm starting the video, so we're almost 45 minutes into the trading day. And just bear with me. I'm just forgot to put my phone on silent mode. Yeah, so we're about 45 minutes into the trading day, and I'm going to do, this will be, I'll try my best to do a quick one. That means 30 or less. All right, I wanted to just share, I got a price alert this morning shortly after the open, and it was at TJ Maxx. If you remember, I was talking about that one yesterday. Started out answering a chart request from a member on the site on Lululemon, which then kind of segued into Yeti, and then the whole home goods thing, and home goods owned by TJ Maxx. And I just wanted to say that we have taken out that 95.61 level. So of course we took the trend line out last week. So this one is objective short right here. That's it. And you can see targets I went over yesterday. 200-day moving averages 91.43, then 87.05. Let's just focus on that now. If and when we get there or start to get there, I'll give you my thoughts. Certainly see the potential maybe for this one down here, 82. So let's just say my current max target. Again, I expect the algos of machines, unless something crazy happens, and it's a get out of Dodge moment. If we go through the 200s like they're not even there, and I know I'm getting ahead of myself. We're way above the 200-day moving averages. But again, a lot of stocks, and not every stock is going to hit the 200s, by the way. But I'm looking for that on the indexes, particularly QQQ, maybe the S&P 500. I just wanted to point that one out. And let me do this. I'm going to go over in this video. I want to just start out by answering or going to some of the comments that were made here. Somebody asked me, can you update the levels of the S&P? I primarily trade SPX. That's the ticker for the S&P 500. And so there it is. If you want to chart SPY, I've been covering this semi-regularly. I cover almost every day the NASDAQ 100 and more often the small caps. But I watch S&P is very important. And I'm going to go over in this video after doing these question updates on the comments. I'm going to get to these sectors, just the top sectors in the S&P 500, and then I'm going to go through that same list that I gave you the other day. I went through my indexes and sector. I have a watch list of various indices and sectors, and I'm going to go through that, but only on one single time frame. I'm going to show you what I'm looking at here. But there's the S&P. I've been talking about this for a while, 502.81, but we have support. You can see first support here is that mine are about 508.35, and then here's your targets. Arrow breaks denote where a reaction is. So I don't. I used to go through drawing all the counter trend and reaction again. I've talked about this recently. I suspect if I'm right, and we take out 433 on QQQ and we get more of those yellow trend support level breaks on the key Mag 7, formerly known as Mag 7 stocks, I think we'll probably, there's a good chance we'll have very little, if any, reaction on those initial targets. So if you're keeping your eye on the prize right now, that's a nice, very logical, and this is just a 60-minute chart, by the way, so it's just kind of a near term. It's not a very aggressive target, and that's just above 459 on SPY. And I replied in there, I'm a day trader, didn't say whether or not he or she uses futures. So I said, let me know if you want ES chart. I'll mark that up for you as well. So that goes to anybody listening to my voice. If you trade ES and you want a chart, I'd be glad to share that. Here's another one. What's your highest conviction short long trade for the next 2 to 6 weeks? Let me just read my response. And I don't mean this in a bad way when I say I don't like that when people ask that. You're welcome to ask me anything you want. First of all, I don't even frame it that way myself. I've learned over the years some of the best looking setups sometimes don't play out as you to the point you thought. I can tell you which ones. Here's my reply. I'm just going to summarize it. You can read it here. But first of all, I threw out in here a lot of the things, and they're all covered in recent videos. But and I need to be clear. Well, first of all, I said I don't like people ask that because I suspect somebody might load up on a single position. And I've done this long enough, guys. I've run this site for years now, decades really. And I know from the comments, sometimes I throw out an idea and I might talk a big talk on it. Semis is a great example. Last year we had a couple shorts, a couple didn't pan out. We've had over the years traded it, much more winners than losers. But then it seems everybody, because I talk about the big downside potential on that or anything else, and I see from the comments, that it seems like people put everything they have into one trade just because it sounds very promising or my convictions might be high. But with that being said, here I don't mind sharing what I think. These are some of my favorite trades as shorts. I went on to list some index sectors and index ETFs. And again, when I very important, I'm telling you what some of my top picks are, but I'm also saying it's contingent. They're not going to play out to the moves I'm looking for unless we break those remaining yellow support levels. You guys know what they are. If you don't, just look at recent videos. I'm talking about I'm going to go through the S&P sectors here, and then I'm going to go through some other indexes and sectors in just a minute. But so some of my favorites, the restaurant stocks. I'm just going over the sector ETFs. There's so many you can dig down if you like that particular one, EATZ. You want to short the restaurant stocks and you don't want to short the ETF, then you can go into my video and I showed you which ones I like better than others. And you went over price targets and you can pick that there. Now, the thing about that is I wouldn't pick one restaurant stock. I wouldn't pick just Chipotle or just McDonald's. I would, if I'm not going to use the ETF, I'm going to pick at least a handful because you never know. If it's dumb luck, you pick the one that just happens to hold up or continue up when the rest of the sector falls. And so, if you're going to trade individual, if you're going to, and I went on to say that, if you have the skill set, the time, the inclination, you're going to, most often than not, I can do this, outperform a sector ETF, long or short. If I'm bullish on the sector, I'll pick the most bullish stocks in there with the most constructive charts. And likewise, same thing being bearish. Now, the thing is, you have to then navigate earnings. You have, any random news events can really move one single company, whereas in the ETF, it's that whole safety and numbers thing. So you have to decide. What most people like the ETFs, and I know EATS isn't very liquid, but if you're swing short, if you're day trading, you don't want to trade a very illiquid ETF like EATZ. But if you're swing trading, what's the difference? The spreads might be 10, 12 cents instead of 1 cent, but you're gonna position for a trade that's going to last for multiple weeks or months even, and that really in the end of the day doesn't make a difference. It's going to track the basket of stocks well. Doesn't matter that it's not a high volume ETF. Then PEJ, kind of related, leisure and entertainment. IAI, broker dealers. Again, that's a contingent on the market coming down and calling that QQQ down to my my target zone, which is down around the 200-day moving averages. I think the broker dealers are going to fall more than the overall market. I think IWM will fall more than the S&P 500 if I'm right. I think the Nasdaq 100 will fall more than the S&P 500. So those are the two sectors, and I've been talking about these for months now. And we've been as we've been topping out here or moving sideways, let's call it. Only in hindsight will we know if we topped out. And of course, VIX would be a long. A long on the VIX is a bet against the stock market. And so those are some that come to mind right away, blah, blah, blah. And there I went on to say about the sector and index ETFs being the safer bet, for lack of a better word. Nothing really safe in the market, especially when you're shorting. You got to be nimble. I always say this if you're new to my this service. I love shorting stocks, but you have to be Johnny on the spot. See, stocks go up most of the time. I don't know the stats, 80, 90% of the time. We all know that. You don't need me or anybody. If you've got a 30-year time horizon, you want to be Warren Buffett, just put your money in the S&P 500 index fund and don't look back. If you're here to game the zigs and zags and enhance your trading, try to beat the market, then that's what this site's about. We swing the rips and dips. But the thing about shorting is you cannot stay too late to the party. It's like a game of musical chairs. When the music stops, you better have a seat. In other words, you got to get out. In a bull market, you get in too early. You can have the worst timing. The market's going to bail you out over time. But when you're shorting, because stocks tend to fall a lot faster than they rise, shorting anything it's like going long and with the fast forward button on 5 times speed. That's what it's like. So profits are tremendous. You can make a lot more in short order. But again, you got to be quick on it. So, all right. So and this time we've kind of been average. Like I said, we've had some sell signals. I got a few more this week. And I've been talking about for the last couple months scaling into or building a starter short position. I'll address the that all-in thing in the next question here. And then I went on to say, look, if two that come to mind, and I've been highlighting recently for individual stocks, if you want the juice. And again, this is going to be largely contingent on me being right on the markets breaking down. That means on QQQ breaking solidly below that 433 support and going down to or below the 200-day moving averages. If I'm right, then I think SMCI and Carvana will fall more. I've given you those targets. SMCI, I've been short that one for weeks, threw it out weeks ago. It's certainly profitable already. I'm quite profitable on it, but it's nowhere near where I think it's going. It still has about another 60% downside to my sold target. Here, I'll cover that for those of you that missed it. SMCI, a single price target at 355.60, cover just above, and that should be, if hit, that's going to be, excuse me, there, frog in my throat. That's going to be about a 60% drop from where we're at right now. And then the other one was Carvana. Carvana I put on months ago, and it's just moved up, made a slight marginal new high, but never exceeded anything. Oh, this is it. That was the old daily chart. It was based here on this one here. And so with that fourth target there, so I may have misspoken. I think when I was replying there, yes, I was. I'm sorry. That's T4. So to stand corrected, I was looking at the daily chart, and those were older targets from a previous chart. And I think we could get there on this one. So T4, just to be correct, from where we're at now is about another 27% below. But based on this one back here, we had this trade, which was taken back here. We hit T1 and we held T1 and bounced. And if we go down to T5, which I do think is quite possible, that's the 70%. So I wanted to stand corrected on that, but also reiterate that I think this is a level you can see just to get this one back to the 200-day moving averages, which seem to be magic numbers. The 200 tested the simple there. There's where we took out the 200 simple, and we took out the 200 exponential. Right now they both come in together, and it's been a while since we visited those. And just to get there, it's going to be about a 34% drop. You can see here on the daily chart, 57.89. That would be this support level right here. So anyway, I wanted to stand corrected and just say that, yeah, I do think there's very much a potential for a 70% drop in this stock. And it's based not just on the daily chart, but this weekly chart. I see a massive bearish rising wedge. I know this stock. I mean, not a analyst in the automotive dealership sector, but I know the nature of this stock. I know their precarious financial position, and I know it's a meme stock and it's a highly shorted stock. A lot of this, or was. I think we've squeezed out. By the way, guys, I'm now that. Just my mind goes tangentially. Yesterday I pulled the short interest for all the Mag 7 and including QQQ and QQQ. Here, let me just show you. I'll do it right now. This is directly from the NASDAQ. Short interest, for those of you not familiar, they report it twice a month only. The dissemination date, it comes out, it's lagged. It's about, I believe, 11 days. So it's really the 12th day because they put it out in the afternoon, in the evening, after the reporting date. So you have the reporting date when all the brokerages report their amount of shares short on a stock. Then that data is collected, aggregated. But again, it's antiquated. I've been doing this now for following short interest for quarter century now, long time, and there's been no advances. I like to think I know the big wirehouses and the companies that have brokerages can tell just looking at their own customer short interest, so they have a leg up on us. But you can get the ebb and flow. Here's the bottom line is you want to be, I like to be a lone bull when I'm going long something that no one else wants to buy, and I like to be a lone bear. I don't want to be short something that everybody else is short. Why? because when you have a lot of shorts already in there, there's a potential for a short squeeze, and that can really hurt you. And it's kind of been discovered already, and most of that move's probably already priced in. You want to go into stocks. This is QQQ, and then we're going back 1 year here, and you can see right now the most recent reporting date was settlement date the end of March, so it's not too long ago. This number just came out. Look at that. We're down to 58 million shares short. You can see down here, and we're coming off a super low level at the end of February. So you look at this right here, you're averaging under 60 million shares. This is what we've been for quite a while here. This is when short interest was high. So you can, bottom line is we're at the tail end, the low end of the range, and it confirms what I've can feel, what I've seen, even comments I've heard on the site. Most bears have capitulated. Everyone's afraid to short the market. Everyone thinks it's going up, and that's when at least it's more favorable to short at that point in time. You want to typically short when you're low short interest. Carvana, you can't get it on QQQ. It's not on the NASDAQ. I thought it was a Fort ticker, but when I type it in, I have to see most trade somewhere else. You can see it won't let me get the short. There's other sites you can get it on. I can just look at the chart and say the shorts have been pretty much squeezed out on a lot of stuff. I went through again the Mag 7, and many of those, some of those are at all-time or at least multi-year or 52 week, I should say, low in short interest, which is a good sign for the market dropping. Because again, when you have a high short interest, another way to look at it, when a stock has a very high short interest, besides the potential for a short squeeze, is that I've always said this: there's only one guaranteed buyer in the stock market, and that's why when I look at sentiment surveys, the surveys that tell they poll professionals and investors, are they bullish or bearish? And they ask, do you plan to buy stocks? And I may be a fund manager, and I may be the most foaming at the mouth, raging bull you've ever seen, talking the bullish talk, telling you I'm going to buy. I plan to buy more NVIDIA. I plan to buy more QQQ. The market's going to the moon. But guess what? I don't have to buy. I may change my mind. Something may come up that changes my mind. The only guy or girl out there in the market, speaking generally, that has to buy a stock are short sellers, because you must close your position out. To close a short, you buy to cover, and so that's what one reason you don't want to short a very highly shorted stock. Anyway, I just wanted to bring that up. That helps mesh with the potential for a good drop in the market that we've finally cleared out. Hit those extremes. And it's also, you can look at the the AAII sentiment survey that's been pinned up in bull territory for a while, bullish extreme. And then back to Carvana. This is it. This is just big. This is resistance. We had resistance here. It was support there. It broke. We waterfall sold down. So that's a very nice resistance zone, and we're just shy of that now. And we have negative divergence. The only other 2 times going back in the history of this stock that we've had on this is a weekly time frame we're looking at, guys. Started trading back here in 2017, right there, right? 2 times we've had negative divergence. And remember, this is a weekly chart. Divergence is on the weekly build over periods of months. This is the big picture. This is the trend trader's chart, not the active trader, not the day trader. This is the investor trend trader. And so you look at Carvana, and it had a clean negative divergence, clear lower lows on the indicators, a beautiful uptrend line in which to short. So you might call COVID a random event, but this was priced in. COVID or no COVID, this was a beautiful bearish rising wedge. You had a technical breakdown, and like so many other stocks, including the market, COVID was priced in. A correction or bear market was priced in, and COVID was just simply the catalyst. And I can tell you time and time again how many charts, bullish or bearish, I've had setting up, and sometimes it's just the technical breakout of prices. And then I watch the bubble TV, I turn on Bloomberg, CNBC, and they have no reason. They try to, and will almost always assign a reason for a rally or a drop in the market. Once in a blue moon, it surprised me, they put up their hands and say, we don't know what happened. Big move today. Anyway, my point was that, first the technicals will set up that a move is coming, a turn, a trend change, via bullish or bearish technicals, and things like divergences and chart patterns like wedges and things, bullish or bearish. Then you get the catalyst, and sometimes it's simply, as I just said, a technical catalyst, meaning a price breakdown, and that's it. Or other times there's a fundamental catalyst. COVID certainly was a fundamental catalyst. Shutting down the economy, yeah, that'll do it. That's a fundamental catalyst, but it coincided with a technical breakdown as well. And just to kind of measure it out so you get the scope, because this kind of segues or parlays into the question that got put to me, big potential. So that was and not from the highs, from the breakdown, a 74% drop. From this breakdown here, 98, 99% drop. So you could have, shorted $1 million and covered for a couple bucks and made $1 million on short. Again, if playing the game high to low, obviously you're not going to milk every penny of it, but you get the point. And if you were long that stock, you'll probably never get to break even, because when you lose, just to show you, to get back up to that point, then you lost 99%. Now you have to make 10,800%. See, that's the way it works when a stock drops. A lot of folks don't realize if you drop 50% on a stock, guess what? How much do you think you have to make to break even? 50% from there? No, you have to now make 100% to get back to where you were. So the more you drop, the more the math works against you. Anyway, that's neither here nor there. So divergent high, 99% or whatever. Divergent high, and I easily can see this stock again, knowing the fundamentals of this company. I could easily see any of these targets. I'm going to give you one more again, and so that's it. It's one of my favorites. Now, obviously, right now the near-term target will be that uptrend line, but this wedge is getting pretty ripe. It's in the area where wedges typically break down, and it can come soon or maybe later. And if it does this and we go up here, I'll still be talking about it at resistance there, and I'll still be maintaining at least these targets, and quite likely this one, and maybe more. So that's it, guys. Again, but it's a very aggressive trade. This thing goes up a lot, it goes down a lot. So beta adjust your position size. If you agree on it, you don't need to put a lot of money in to make a lot of money. If you're looking for a 70 to 80% drop, maybe plus. And that way, that's how I trade these things. So you can put a small enough amount in. Let's say you're going to allow it a short here to go up to a little bit below that, above that trading range. Well, you might have to give yourself a 30, 40% stop. Most of you are probably saying, Randy, that's insane. Well, it's all relative to how much you lose in dollars, not percentage terms. If you put a fraction, take a quarter position, your normal trade size is $10,000. You can take $2,500. It's that way. If you're stopped out and you give yourself a big percentage stop loss, you're not gonna lose any more than you would on trading the S&P 500. Likewise, is it worth it to only put $2,500 in a trade when you usually trade $10,000? Yeah, if you're going to go for a 70, 80% return, you're going to make more in dollars than you would on a $10,000 trade in SPY that you're going for an 8, 10% swing trade. All righty, that's that. Let me now go into the final question. Would you clarify what a short all-in you are? You breezed through it on the video. Okay, that there's not a firm. It just means I have a pretty heavy aggressive short position in equities, and that's via future stocks, ETFs, the VIX long. It's close to as much as I plan to ride down to my current preferred swing target, because I think we'll go on to break QQQ. I think there's a very good chance, especially that I've seen additional evidence build this week, and I'm going to go over that evidence in this video here. So some of the evidence I've seen this week that's given me more check boxes, and now you can like yesterday I told you I shorted not the breakdown of QQQ 433, but rather the rally into resistance, which is about where we just hit again. So like I said, I'm seeing technical evidence continue to build the case for a likely and imminent double-digit drop in the stock market. And I've seen a few more boxes checked off this week. That is, such as key sectors or stocks breaking down. I'm going to get to that in a second. Trend indicators flipping, treasuries moving deeper into my orange zone. So everything I've been talking about for months now, and I told you before that would be one of the big ones, interest rates and treasuries. So like I said, it's not, We don't have the highest probability sell signals. They're going to come when the rest of everything, the yellow levels that I've been highlighting on the Mag 7 and the indexes, when those are taken out. But now let me go to the charts, and then I can try to get this video covered under that, around that 30-minute mark. Real quickly, these sectors in the S&P 500. This is XLK, by far the most important, largest sector, right on the line. So it hasn't given out yet. You've got the 50-day moving average just below. That's an important level. And 204, we'll call it 204. And again, I believe it appears, it looks to me imminent. I believe it's going to happen enough to me that it's worth it to, to get pretty aggressively short, just in case it happens on a big gap down. Remember, you can always add to your futures, if you're awake at 3 in the morning, if something goes on, but you can't add to your, Carvana short or your, SMCI or any of those other ones, because they're stocks. You're going to have to wait until the morning. And even then, it's a pain in the ass to trade in pre-market. You can only use limit orders, and there's not a lot of liquidity. So that's XLK. We're not there yet, but close. And that'll be a big old check mark when that 204 level goes. XLV, as I went, we already got a check mark. We already broke down. 3 days of back testing followed by a rejection, and we've been moving lower. So that's a big fat check mark. Second largest sector in the S&P 500. XLF took out the yellow trend line, which was important. It broke down, back tested, finally rejected, and it's on that yellow key support with the 50-day just below. So I can't give it a check until the end of the day because it's a daily chart, but we're a hair below 40.50 right. Well, we're right on it. We're on 40.50. You can see the white box if you can't see it exactly 40.50. And see, I'm going to round that off. My number there says 40.53. So anyway, I'll make it. Let's say everybody loves round numbers, so let's make that. So today can make or break XLF in my opinion, and if we get it, then that's going to be check mark for another one of the top 4 sectors. XLY already broke down here, broke below the trend line, made a perfect back test, moving lower, but my yellow key support is 177.50, and we're right there again. So so far what I just showed you is 2 of the 4 3 of the 4 are right on that support. And I do like to say support is support until I'm less broken. So to be aggressively short now, I'm an aggressive trader. That's very aggressive. You're anticipating a breakdown. Like I said, do you do short right now? No, but do you short, the bounce backs to resistance? That's kind of the mode I'm in. And then let me just cover the fit. There's XLY. I already covered that. That's the 4th largest sector. The 5th largest is XLI. Got price support here about 122.68, but it already broke the trend line. See, that's the other thing. A lot of these guys are below trend line now. They just need to break those next support levels, and they're pretty big ones. I think that'll make a big difference. XLC, communications. This is all just really it's all mostly all alphabet, really, is all it is. So alphabet needs to break for this sector to go. XLP, staples, clearly broke down below my yellow uptrend line and looks to be maybe bear flagging right now. And then the sectors that are hanging in there, like I talked about, are the ones you don't want to see doing good right now. You do want them, if you're a bull in the stock market, you do want them to break down. And that's energy and utilities. Those are defensive sectors. Defensive sectors are where institutions will put money if they foresee a recession or an economic slowdown coming. Why? Energy is not necessary. Energy is more so the inflation trade. I should clarify there. Utilities are a defensive sector because they're utility companies. The last thing you're going to stop doing is paying your electric bill. You might cut back on the Netflix subscription. That's discretionary, but you're not going to stop paying your electric bill. So anyways, that's that. And it doesn't really move the needle. Now to wrap the video up, I'm going to go through the same indexes and sectors list that I had covered in yesterday's video. I'm going to put up the PPO histogram. If you remember, a big thing for me was last week we had the bearish PPO crossover on QQQ. I'm going to turn off the lines for a second. what we can do is park the RSI, give us a little more real estate here. We'll even park the PPO. There it goes, pin. All right, we'll even park the PPO for now. Then remember, the PPO histogram, these green and red bars, are simply the differential between the PPO lines. So when the PPO line, the blue one here, is above its signal line, the white line, it's green. The higher they are, the farther apart, the higher these histogram bars. And when they cross, like they did right here, and then bullish cross here, the histogram will cross. So we can just park this because the histogram just shows you nice and clean. Like I said, it's a pretty effective trend indicator. If you're new to the site, I'll just kind of use it on QQQ here. So you just take the box and you look at when the trend is bearish. And again, it doesn't look like much. This is a weekly chart. These are mostly double-digit moves. From here, you had a bullish cross, and it told you long and strong. There, it got that counter trend rally. It was bullish. Here, it was bearish. And so it's done a pretty darn good job. There was COVID, and you can see the PPO trend indicator was bearish. And they come pretty early on. That's the thing. So we have that. We had it last week. I highlighted it then. And today, we're even deeper in the red so far. So it's not a whipsaw. There was a whipsaw right here. But then you had a couple flattish. The PPO was flattening out there. I like to see these clean hills like this. This is a clean hill, clean separation, I call it. Nice big green hill, nice big red hill here, big green hill, and there's your crossover. So, all right, and so there's that. Now we're going to go through the all the other. Again, it's just a kind of a compilation of various sectors, some more important to the stock market than others, and some of these are actual indexes. And what I'm doing is just going to go through and show you which ones have crossed. And so I have quite a bit. Now, today is Thursday. It is 10:45 now as I speak. So we are only an hour and 15 minutes into the trading day. A lot can happen today and tomorrow. So this could get undone. But as of now, we have a bearish crossover. You can see the PPO is at negative 0.10. And I'm not going to do it on each and every one. You can replicate these on your own, but I'm just going to show you here. There's a red box, with the crossover. Red there. Red here with one single whipsaw right there in the middle. Even if you took it on faith, you would have got short here. You didn't make anything, but you didn't lose anything. And if you were bull and you got out of your XRT, then that was you were glad that you deployed that capital. You didn't just have dead money for almost a year there, 6+ months. There was one little whipsaw, and then it said, hey, nope, get back short, and you caught the big move there. You got the juice. Again, it's not perfect, but look back here, big green hills, said long and strong throughout there. And I always warn folks that, look, when you get into a choppy sideways trend, this XRT has been going right through its 200-day moving averages. You tend to get more whipsaws, and this trend indicator doesn't work as effectively. It's a great trend indicator when there's a clear trend, bullish or bearish. Either way, I'm just pointing out how many crossovers we've seen so far this week. And like I said, I'll do an update. I'll maybe just speak to it tomorrow as we head into the close of the week. But I can just tell you now, you want to keep it simple, guys. Look at where we're trading right now. I'm going to go over the ones that have crossed over. Unless the market is up substantially, these aren't going to flip. You're going to get these confirmed. Remember, it's a weekly chart, so all that matters is how they print the close at 4 p.m. tomorrow. And so basically, if the market is at where it's at today and doesn't go anywhere until tomorrow at 4 p.m., then you're going to have these bearish PPO crossovers. So there's retail. XBI is biotechs. I covered this recently. I had a false breakout on some of the biotech sector ETFs. This is across last week, gave us a trend change. The last one was right here, and you would have made a nice short, or if you don't short because you think it's anti-American or whatever, then you at least sidestepped a drop of about 25% in your longs. And if you did it here, you either made double digits or you sidestepped a big drop. And you can see, you go back in time, it's pretty fairly reliable. It's not perfect, but a pretty good trend indicator. So there's two sectors. Clearly, this is week 2. So there's no chance, by the way, of XBI this week. It can't rally enough to get back above there. So that one's on a the trend sell signal on this one trend indicator. Utilities, solidly green. Okay, Randy, here's one. What I just say, utility is a defensive sector. You want this sector. This is the one, first of all, does not have hardly any impact. It is one of the 11 sectors of the S&P, but it's like less than a 3% weighting. So there's that, and it's a defensive sector. It shows you what's going on right now in the economy is that this one's doing well, just like gold, getting a flight to safety bid, things like that, things that really showing a risk-off market, transitioning to that is. RSP, equal weighted S&P, that one's got a little work to do, but you can see the slope. Just like I predicted a few weeks ago, we'd get the crossover on QQQ. It doesn't take a skilled technician to say, okay, where does this look like it's headed? Sometimes it looks like you're going to cross, and then you don't. That does happen, but you can also look at, this is why we swing trade. This is why, Warren Buffett does what Warren Buffett does. I do what I do, and that's swing and trend trading. You can see these green hills and these red hills, they don't last forever. There's no set frequency. Sometime in a big trend, that was the first bear trend in a while, they can last longer. And there's an example of, look like we're going to get a bullish crossover. We didn't. Trend stayed bearish. Looked like we were going to get it again. Didn't. Looked like we were going to get it again. And it just said if you were going to use that indicator, you would have stayed short through that point. And then, we were short the market there, and then we were long that and both two big bear market rallies back then. We were long those for other reasons. We were long those for price targets being hit, support levels, positive divergences on the 60-minute chart, key stocks at support, but it kind of jived with, so we were able to game as an active or even regular swing traders those counter trend rallies. But it told you a trend trader, hey, you might want to keep your head buried in the sand until you start going green here and there, so forth and so on. And again, that's the equal weighted. It's not the actual. I'll get to the S&P in a second here. QQQE, equal weighted NASDAQ 100, clearly on week 2, clear sell signal. Been a very reliable trend indicator. Again, sometimes you get some whipsaws. Nothing is 100%, but for the last couple of years, it's been pretty solid. SPEW, the equal weighted S&P, which is RSP. I just covered that. This is just the actual index. Railroads, week 3, clear bear trend. This is important to the economy. If railroads are dropping, what's going on? Where's this rosy economy there? The bulls are talking about if you're seeing transportation rolling over. If the economy is booming, they're moving a lot of goods on rails and trains, planes, and automobiles, or trucks, that is, and vice versa if not. So it look pretty clear. Look how you can just swing this sector up and down. It tends to be the trends are a little more clear. It's either going up or going down, and there it is. So you recently got we're in week 3, 0 chance this week of flipping back to bullish. XLB, basic materials, again, another one that is a sector of the S&P. It doesn't move the needle because the weighting's low, but it is one, and probably the biggest one, that is bearish when it's going up right now, because this is basic materials. Inflation is everything to this market. Interest rates are everything to this market. And as long as basic materials are going up, inflation's going up. So no bueno the fact that this hasn't crossed over. PBE, biotech, another biotech ETF, week 2, solid PPO crossover. IAI, broker dealers, I mentioned this is one of my top picks. It hasn't crossed yet. Going to, if I am right on my call on the market, and that is very conditional, obviously, going to be right or wrong, I think this one will outperform to the downside. I think you will. When I say that, I'm talking about outperform the market, and the market's really, we'll call it the S&P 500. I think there's, I just know that for a fact. The fortunes of the broker dealers ebbs and flows with the stock market. In a bull market, everybody's buying stocks. In a bear market, most people don't. I am, a rare breed. Not a lot of. There are some professionals and there's some individuals that are very comfortable shorting. I'm one of them, but most people don't short stocks. I think you know that. I'm talking about the general public. So that's where their trading volumes, their commissions, everything just plummet when you go into a correction. So one of my favorites, I covered it recently. Anyways, let me get back to the weekly chart, and hasn't crossed yet, but I don't. We already have. Again, that doesn't matter. We're already ahead of it because we already broke down from the bearish rising wedge. So this one is an active short. I covered it last week and again yesterday, I believe. Next up, XLF financials. No bearish PPO crossover yet. Obviously, getting very close. We're at 0.16. See the downtrends when we had the the bearish PPO crossovers before. Whoosh. Right there, we got that right there. It was quick. Yeah, and there would have been sell signals on these 60-minute and daily charts, just like now. We haven't crossed yet, but you can be short the financials. In my opinion, we put in a divergent high with a bearish engulfing candle. That's right there is an objective short. It was highlighted at the time. That's the bearish engulfing right here on April 1st. Then we broke the secondary trend line. That was after breaking the primary trend line and backtesting, rejected. Broke my benefit of the doubt trend line, followed by an impulsive rejection. There have been and still are many reasons to be short, and now we're on my yellow line, which I covered earlier at 40.50. And when that goes, that'll be, in my opinion, really the last objective short entry. Then you just position up, you've got a full position in it, and then you just ride it down to at least 37 right there, 200-day moving averages. So and that's if you trade the sector ETF. You get, from where we're at, another 8.5%. You trade some of the individual stocks, and you get quite a bit more. Okay, next up would be GDX. We were long off the lows recently. I've got a short on it right now, and that's just a pullback trade. But this is not a sector of the S&P, so this doesn't affect the stock market. It's just in my list here. EEM, emerging markets. I covered that yesterday. Anyways, that's not the U.S. markets. It really doesn't matter what I'm talking about, or it's not related to what I'm talking about. But I did cover it being at resistance yesterday, and I said it will likely fall with the U.S. markets if my analysis is correct. XLK, tech sector ETF, just like QQQ. We're now in the third week of solid. This one actually, QQQ, what did I say? We're in the second. This one crossed over 3 weeks ago, and there is zero chance of it making this being a whipsaw, at least as of this week. We're going to close solidly the third week down. Even if we rally back a little, this has very little chance of inverting or crossing back over. And that's, again, the most important sector of all. It is over a quarter of the S&P 500 in just this one sector, and it's over half of the NASDAQ. VTI, Vanguard Total Stock Market ETF, very close, 007 right now, 0.07, meaning any more downside, especially if we close, red today and then red tomorrow again. A solid red close would most likely do the trick. And you can see it's been pretty darn reliable. I see one little whipsaw. It was a bull trend here. And so it told you at this point right here, it said bullish crossover to a bull trend. That was right there that week. And other than one single week where it was a whipsaw, it said stay long up to, what was it, right here? Right there, that red candle. And then it said get short. And again, it's not a bias standalone. For me, it's not a standalone. It works in conjunction with other things. All those other sell signals on the shorter term, the 60-minute and daily charts and everything that we got. And you can see throughout this point here, most of the bear market, it was solidly red right there. And so there it is. Moo Ag, I covered that yesterday. Again, this is kind of an obscure sector. Wilshire, I already covered. The VTI is going to look similar to this FTSE. Wilshire 5000, I'm sorry. Investment brokerage, covered that in IAI. It's going to have a lot of these. Silver, again, silver. It's nothing to do with the stock market. Metals have been bullish. Mining, I covered this one yesterday as well. It's on green right now, but on the daily chart, it looks to me ripe for a correction based on the technical posture there. And again, not going to really move the market too much. PEJ, also highlighted this as one of my favorite shorts. It's plenty of room to go before it even triggers a trend change signal here. But like I said, I've highlighted this repeatedly lately, and it's an active short now on the site. broke down yesterday and it's still red today. 110% an objective short entry right here, in my opinion, as would be any kickback, back test of the trend line. You just wouldn't want to see a solid recovery back above it. Back to the weekly. SPY getting close, not there yet, 0.009. And again, just a great trend indicator in the last few years. Gold, again, gold's gold. I'm just clicking in order, guys. When I hit the space bar, it moves to the next thing in my list. So you're going to get some here that aren't related to the stock market, like the metals and things like that. The global Dow getting close, but not there yet. QQQ already covered. SMH, this particular semi ETF, not there yet, but look at the slope. Look at the slope of these lines heading down. Again, what happened right there? You got the cross, and you got the biggest drop in at least in the last year. There was a whipsaw. There it is. Again, nothing's perfect, but even if you took it on faith, you closed your longs and then you got right back in the next week. Again, if you were just using this as a standalone. So you were long and strong throughout that whole thing there. And you've been long and strong throughout this. Maybe you're still long now, but again, we have the semis as a short. I do as an official trade on the site right now, trying to get ahead of that one. And NASDAQ Composite Index. This is the composite. That's thousands of stocks. That one has triggered as of this week. NDX was ahead of it. What does that tell me? It tells me what I've noticed and pointed out. The leaders have stalled. The things that are the generals are no longer going up. That's why the NASDAQ 100 crossed a couple weeks ago. The composite this week is crossed down, and unless it rallies today pretty good and into tomorrow, you're going to have the first bearish crossover on the NASDAQ composite on the weekly since this point right here, that candle. And from there was considerable downside, even though you had a little pop first. And then before that, you can see. And here was red throughout most of the big drop down into those lows, other than that, a couple counter trend rallies. eDow, the equal weighted Dow, solid crossover to, this week, again pending tomorrow's close. MUB, muni bonds, no bueno for the bond market and municipalities. Homeowners are already stretched. When the municipalities, their borrowing costs go up, they, like the federal government, they have bonds rolling over, they have to refinance. How do they do that? Municipalities make their revenue off property taxes and all that. Articles all over Barron's and the Journal lately about the unaffordability. It's not just Florida. I'm in Florida. If you're in Florida and if you're on the water like me, I don't have to tell you how insane in the last few years the insurance increases have been, but it's everything. Car insurance going through the roof, homeowners insurance, property taxes. That was an article I was reading in the Journal today. Fortunately, at least for me and those in Florida, if it's your primary residence, you have your Save Our Homes provision where you're locked in, you're ratcheted in. They can only increase your taxable base by 3% a year on property taxes. But if you go to sell, all right, FXI, that's China. It doesn't matter. We're going over the U.S. markets here. Staples, still in the green, but these are staples. They tend to do well in a recession, or relatively well. Another China ETF. I'm just skipping over semis. Again, you can see the momentum is really rolling over pretty hard. That's what these momentum indicators tell you. You can see the slope heading down, crossover. There was and guys, this is why I'm pointing out these times where it looked like you're going to get the cross and it's a head fake. So whether you're bullish, bearish, I don't even want to speak in those terms right now. Just be flexible. If the market holds 433 on QQQ, or it dips below it, looks like the real thing, I get excited, I even have more, but then boom, we ramp back above it and we keep going up, then that's going to be a powerful whipsaw. So you just have to know that this is a highly accurate and effective indicator, but it's not 100%. There are whipsaws, and just keep that in mind. However, it's like anything. It's like betting. Going to Vegas, you want to put the odds in your favor. Any game you play or anything in life you do, you want to put the odds in your favor. You commute to work all the time and you're worried about getting killed in a car accident, buy a Volvo or get a big SUV, something with a high crash rating. You're putting the odds in your favor that if you get in a car accident, you're not going to be killed. So it's just like that in life. It's just like that in trading. There are no certainties. There are only probabilities. And so the probability says, we're going to cross over, number one, with the slope going down. And then when we do, we're going to have a trend change, not just a small drop in the market. Euro, US dollar, that's nothing to do. This copper stopped trading. It's a copper ETF. ETN was delisted or stopped trading, dissolved by the company. Energy, of course, this is one that is strong, but as I said, it's a sector in the S&P 500, but one sector you don't want to see going up if you are a bull, or Powell wanting to cut, because that shows it's reflecting the surge in crude prices in recent months. XOP is another energy sector ETF, so same thing. Bullish on this is bearish for the stock market. XES, another energy sector ETF. UUP, the dollar, another thing bullish, bearish for the stock market. Why? Because dollar up equals stock market down, and vice versa. So right here, you can see there's where the stock. Oh no. UUP is right here. This is how we've traded recently. So right there, the dollar started falling and the stock market bottomed. That was October. The stock market went up. Dollar went sideways, so it didn't really mean much because we weren't going up or down. Then the dollar started rising. The stock market had its biggest correction last year when the dollar went up. Dollar started falling from here to here. The stock market went to new highs. Dollar has been going up and is going up, and just recently made a trend change to a bullish PPO crossover. So that is bearish for the stock market. And last but not least is USO. And again, that is crude oil, that is energy, that is inflation, that is bearish for the stock market. So there it is, guys. Certainly didn't hit my 30-minute mark. But what I just did is showed you again, ignore China, ignore those obscure, things that aren't part of the stock market, but pay attention to those that are. And what I just showed you is the vast majority have either crossed recently, or a bearish crossover appears to be imminent. And it's such it's morphing me back from that active trader mentality into more to swing trading mode, and giving me a little more patience and a little more confidence to really short the rips, and any rallies back into resistance. This is QQQ on a 60-minute chart. There's QQQ on the 15-minute chart, and we continue to zigzag down. And so when you are a bear or a short seller, you need to just you're just a bull in reverse. Bulls buy the dips, short sellers sell the rips. And ideally, strategically, you want to sell rips into resistance. Hard to tell which one's going to stop that, but what starts to we'll call this downtrend into question is when you start popping above these previous reaction highs, especially if you move back up to and above the top of the range. And then all those bearish PPO crossovers that have occurred or look like they're about to occur, well, if the bulls can do this right now, they're not going to happen, and the ones that have already happened will be whipsaws. So it's not what I think is going to happen, but it's something I will most certainly react to if it does, and it'll be incremental, not all or none. There is not. If you're wondering where's my line, do I stop out? That's why I do these hour-long videos. It's a combination of many variables: crude oil, treasury bond yields, sectors, and the indexes themselves, and price action, and everything else. All right, guys, I'm going to stop it here. This has been Randy Finney with Right Side of the Chart. Have a great day.